I mentioned my friend Nick Sleep, and in fact, I'm just going to do a search to see if his letters are there, so I can tell you, whether I'm because I always worry whether they're taken down or not. Yeah, so I think if you do a Google search, just Nick Sleep letters, it'll bring up some links which will give you all his letters. I think those are like the Dead Sea Scrolls. They should be required reading. So he ran a fund from 2001 to 2014. The entire thing is in a single PDF. And what I would do is I would start with the oldest letters and then work my way forward. And I think it would be a tremendous education to go through that. So just to give you a little bit of the Cliff Notes version of the Nick Sleep letters, is Nick understood this notion really well, that when you find great businesses with great runways, run by great managements, that you take the mindset of an owner and not an investor. So in 2013, when he was, just before he shut down his funds, he was running about $3 billion in capital. And 40% of the capital was invested in Amazon. So about 1.2 billion was in Amazon stock. And then Costco and Berkshire Hathaway made up almost the rest of the portfolio. So 90% of the portfolio was Amazon, Costco, and Berkshire Hathaway. Okay, that's how he was running his portfolio. The UK regulators were giving him a lot of grief, saying you cannot have all this risk in a portfolio with so much money in one position, and that you need to diversify. And it went against every bone in his body because he understood Amazon really well. He did not want to change, even 10 years from now, his Amazon position, because he understood that business was exceptional. At that time in 2014, Amazon was $300 a share. Now it's $3,300 or more than that. So what he did with his partner Zach is he wrote to his investors saying, "Look, I'm returning all your capital. I'm shutting down my funds. We've had a good run." They compounded at about 20% a year for 14 years. And Nick and his partner, I'm estimating, got maybe somewhere between 100 and 200 million each from all the fees and gains and such that they had made. And they kept their stake in these three companies. So for example, if Nick got 100 million, half of it was in Amazon and maybe the rest of it is Berkshire and Costco, and he kept it that way. And you can imagine what that did to his net worth. It's worked out very well. And he pretty much outperformed almost any managers I know of, and with doing no work. He's been driving these race cars on racetracks. He's taking long bike rides. He's go skiing. He's not doing much work. I would say in terms of, actual work, I don't know, maybe 100 hours a year or something. So the learning from him was that when you identify and find these exceptional great businesses, which have very high returns on equity, very long runways, very great managers, very deep moats, you go all in. And ideally, you try to find them small, and then it's set it and forget it. And it's similar to what this book in 1972 came out, talks about the 100 to 1 in stock market returns. I think even though the book is 48 years old, I think it's timeless. So I think these were the big lessons for me, which is I was always an investor who said, okay, find an undervalued asset and sell it at full price. Like, for example, when I bought our investment in Turkey, I said, okay, this is very undervalued. We'll have a good run. At some point, we'll move on. I don't think about it that way anymore. We own 1/3 of that business, which means that out of the 12 million square feet, 4 million square feet belongs to us, my fund investors. I like that business. The managers are really good. And we will keep that business for a long time. And so that's a completely different mindset from what I had before when I was trying to do these precise calculations of intrinsic value and all of that. We're not doing that. So that's the big change.